I'm calling this no hype real estate investing. That's a picture of what I was doing last week, which was canyoneering down in southern Utah. Lots of fun there. But when there's 1,000 people coming to a webinar, you got to shave. So I just shaved a few minutes ago just for you guys. All right, here's what we're going to cover today. We're going to talk about the pros and cons of real estate. I'm going to try to help you decide, because I know there's a lot of people out there wondering, is real estate right for me? Is this something I should be doing? We're going to talk a little bit about real estate education and how you can get it. We're going to talk a little bit about leverage. It's a hot topic these days. People who have been highly leveraged have done very well over the last 5 years. But how much leverage is too much? We're going to talk a little bit about the dilemma of the minimum investment, another topic we cover in the No Hype Real Estate Investing course, at which point I'll introduce you to the course, show you what's in it, and then we're going to do the Q&A. All right, so let's talk about the pros and cons of real estate, and there are many of each. Let's talk about the pros first of all. High returns, okay? This is why most of us get interested about and excited about real estate investing, because the returns are high. What do I mean by high? Well, a pretty low risk real estate investment, you can expect a return of around 6%. A more high risk one is not unusual to get 12 or higher, especially if you add leverage. Could be 18%, even 20% plus. And so it's pretty exciting, right? Because when you're growing your money at 10, 15, 20%, great things can happen. Financial independence can be reached very quickly. You can supplement your income very quickly. Your money grows, you outpace inflation. There's lots of good things about high returns. All right, here's another reason. It tends to have a correlation with stocks and bonds, not a correlation of zero with them, but a lower correlation than one. And that's useful. If you look at the science of portfolio theory, you look at building a portfolio, the actual mechanics of it, what you want is asset classes with high returns and low correlation with the other asset classes in the portfolio. And real estate does that. And so often for anybody to start reaching for any sort of alternative investment, anything beyond stocks and bonds, first thing they usually add to their portfolio is real estate. All right, here's another one. This one doesn't matter as much to me, but it does matter to a lot of real estate investors. A high proportion of your return when you're a real estate investor comes as income. That's a good thing for a few different reasons. But especially if you're looking to supplement your income or you're living off this investment income in retirement, this is often a good thing. But think of it this way. For example, if you have a stock mutual fund and its return is 10%, typically about 2% of that will be income, and about 8% will come as appreciation. Now, it's a very tax efficient way to get your return. But if you actually want to spend some of that money, it does mean you have to sell some shares. Not the end of the world when it comes to a mutual fund. But it can be the end of the world when it comes to a real estate property, right? You can't go sell 5% of your real estate property. Not very easily anyway. Not only does nobody want to buy 5% of a property, but it's got some transaction costs and some illiquidity associated with it, with a lot of aspects of real estate. So you can't do that. So it's good that a high proportion of the return comes as income. If you had a real estate property with a return of 10%, 6% of that might be income. So instead of 20% of your return being income, like with an index fund, 60% might come as income with the real estate investment. So that's a pro for a lot of people. All right, another one is that real estate appreciates. It goes up in value over time, right? You want appreciation, and real estate tends to appreciate in the long run. If you look at what properties around you and your city were worth 10 years ago, 20 years ago, 50 years ago, they're worth a lot more now, right? No matter what happens with the income in the meantime, that's a serious pro of real estate. Real estate is also possibly the easiest way to leverage your investments. Okay. You can leverage just about anything, but the terms on the loan tend to be best for real estate. It's not that hard to get a 30-year fixed loan that's non-callable at a low interest rate. That's not unusual at all for a real estate investor. And so you can do that much easier. There's no margin calls, like if you're borrowing against your stock portfolio. That's definitely a pro of real estate. Okay, here's another one. Depreciation, right? You've heard about depreciation. But a lot of times, the income you are getting, especially in equity real estate investing, the income you are getting is not taxable income, at least not for a long time, and potentially not ever when done correctly. For example, it's not unusual for, say $100,000 investment into a real estate syndication to send you $4 or $5 or $6,000 in income and have all of it covered by depreciation, meaning that's all tax-free income that year. So that's a pretty cool pro of real estate. All right, here's another one. You can exchange properties. Let's say you don't like the property you have for whatever reason. Maybe you've fully depreciated it already, or maybe you just want to be in a different property. You can sell that one and do what's called a 1031 exchange, buy another similar property, and you don't actually have to pay capital gains taxes on the one you sold as long as you buy another one within a certain period of time. You can't do that with a stock. You can't do that with a mutual fund. If you sell one mutual fund and buy another one, guess what? You're paying capital gains taxes on that. Not the case with real estate. Okay, here's another one. We're going to talk in a few minutes about the real estate spectrum. But the fun thing about real estate is you can invest all along that spectrum, that continuum, all the way from very active investments like building stuff from the ground up, like fixing and flipping, like running a short-term rental business, to very passive ways to invest, such as syndications, private funds, REITs, even publicly traded REITs in a mutual fund, very passive way to invest. And you can find your place along that spectrum. So that's a really cool aspect of real estate investing. Real estate markets tend to be less efficient than the publicly traded stock markets. All real estate is local. And if you know that market well, oftentimes you can pick up some real deals and you can add some real value there. You're much more likely to do it with a real estate investment than you are picking stocks. All right, let's talk about the cons, because there are cons of real estate, right? And the thing I like the best about the course we put together is we tell it like it is. It's no hype, no nonsense, high yield. This is the way it is. So we're going to tell you about the bad things too. So here's one of the worst parts of real estate. There's a lot of bad people in real estate. It's like a lot of things in the financial services industry. There's people out there that are fraudsters, they're running scams, they're incompetent, whatever. And you run into those. I've had people try to give me loans that were inappropriate loans. People encouraged me to buy when it wasn't proper for me to buy. I had a real estate syndication that I'll probably end up having a total loss on because the operator fraudulently obtained additional leverage that he wasn't supposed to, according to the operating agreement. There's a lot of bad people in real estate. And so that's one downside, is you got to have your head on a swivel, as we say in ice hockey, looking for those, fraudsters out there. Okay, here's another one. Leverage, right? Leverage is great when it's going well. When things are falling in value, leverage is not so good. And that's one downside of real estate, is it's almost always leveraged in some way. And leverage works both ways. Okay, here's another downside. Many parts of real estate have aspects of a second job, particularly if you are a fairly active direct investor. Most of us already have one job. Many of us are already working 1.5 FTEs at that job and aren't exactly looking for a second job, even on the passive side. The amount of work that you have to put in order to be successful is significantly higher, maybe an order of magnitude higher than what it takes to run a boring old index fund portfolio. So that's a significant downside of real estate for many investors. There are ways to minimize it, of course, but it never goes away completely. All right, here's another one. Tenants. Okay. When you own real estate, in order to make any sort of good return on it, you generally are going to have tenants living there or working there. And tenants do crazy stuff. They have 30 cats. They tear the place to pieces. Their standards of cleanliness are lower than yours. They invite all their friends to come over and live there. They don't pay the rent. They do all kinds of crazy things that you wouldn't think normal people do. And you've got to deal with that. You can hire that aspect out, but whether someone else is doing the managing or not, there's still tenants there. And that can be a downside of real estate. Here's another one, illiquidity. It takes time, it takes money to sell properties, even many, passive opportunities, syndications and funds. Your money might be tied up for a decade. And that's just not the case when you're investing in mutual funds. With ETFs, you have minute to minute liquidity. With a mutual fund or a stock or a mutual fund, you can sell every day the market's open and get all your money back in cash. The next day, as soon as it settles, you'll have it back. That's not the case for many real estate properties. Your taxes get more complicated. I did my own taxes for years and years and years and years. But when I got heavy into real estate, I decided, you know what, this is not worth it. I think I filed in 9 states last year. And so you can expect your taxes to get more complicated when you are a real estate investor, whether on the passive side or the active side. Here's another one. All real estate is local. And so the rules change, whether you're in California or New York, even whether you're in Modesto or San Francisco or Los Angeles. The rules are different, and they can change even neighborhood to neighborhood. And so you've got to understand that. No matter what level of real estate investing you're doing, you've got to understand what rules apply to what you're doing in that particular area. Here's another one. You're never going to be sued for something that happens with your index fund, right? It's just not going to happen. But if you own an apartment building and somebody gets hurt at that apartment building due to something you didn't do but should have done, you've got some liability there. You can be sued. You got to buy insurance. You could go to court. You could lose, the property. You could lose more than the property if you haven't properly protected it. But that liability is kind of unique to real estate in that respect. All right, here's another one, right? There's a lot of expertise that can be required, particularly on the more direct side of investing, the more active side of investing. Just like you have the opportunity to add alpha, to add additional return to your investment, you also have the opportunity to subtract it. If you don't put in the work required, if you don't have the skill required, you can actually subtract value from your investment. And here's another aspect. Most of the largest companies in America are publicly traded. They're stocks. They're in the stock market. But that's not the case with real estate. Most real estate is in private hands. And so that introduces, a less functional market and higher transaction costs and less transparency. And so that does have some downsides to it. All right. So is real estate right for you? Well, you need to ask yourself 3 questions. The first one is, are you interested in any of these 3 things? The first one is increasing your spendable income now, money you can spend now. The second is speeding your pathway to financial independence. And the third one is diversifying your portfolio away from stocks and bonds. If you're not interested in at least one of those 3 things, real estate probably is not right for you. The second question you should ask yourself is, are you willing to get more education and do more work than would otherwise be required? There is another pathway to wealth that works extremely reliably for physicians. If you simply save 20% of the money you make as an attending physician and you invest it automatically into a boring portfolio of stock and bond index mutual funds, you will reach financial independence and you will retire comfortably as a multimillionaire. Okay. If you want to do real estate, if you want to increase spendable income, if you want to speed your pathway to financial independence, if you want to diversify your portfolio, it's going to take more work than that. You can't just automate it and kind of forget about it. It takes more work and it requires you to learn a little bit more. That's why our no hype real estate investing course is over 3 times as long as our Fire Your Financial Advisor course. There simply is more stuff you've got to learn in order to do it effectively. And the third aspect is, are you willing to deal with some additional hassle? Because there's going to be some additional hassle, whether it's filing taxes, whether it's evaluating syndications or fund managers, or whether it's actually going out and talking to tenants or selecting properties to buy or fixing a toilet. There's going to be some additional hassle. So if you're not willing to take on at least a little bit of additional hassle, then real estate may not be right for you. But if you can say yes to all 3 of those questions, then I think you ought to proceed. And I think the best way to get started is to take the No Hype Real Estate Investing course that we put together for you. All right, let me tell you about a couple of people. This is what I was doing last week. I was canyoneering down in southern Utah. And this fellow on the left is a guy by the name of Murray. And Murray's in his early 50s. He is a contractor by profession. Spent his working years building stuff and upgrading and renovating stuff. And about 10 years ago, he decided he was going to get into real estate investing. And at this point, he's got 48 doors under management. He's got most of those properties paid off, and he has an income between 40 and 50,000 from those properties, of money coming in from those properties every month. Work is optional for him. And so he can spend time in southern Utah doing stupid things like going canyoneering. Now, on the right side, you'll see Murray and me at the bottom capturing the fine Dr. Christian Feinauer, who I've been adventuring with ever since we were in the same medical school class many years ago. Christian Feinauer has, probably a pretty similar income. But where does his income come from? It comes from clinical work. He sees patients 15, 16, 17 shifts a month, days, evenings, nights, weekends, holidays. In fact, he showed up to this trip late. I had to make an extra trip back to the trailhead to pick him up. And, he wasn't able to come out for the whole trip because he had to work. And in fact, he worked until 10 o'clock the night before and then spent 5 hours driving until 3 a.m. before getting 2 hours of sleep the day before this picture was taken. So many of you find yourselves in the same boat as Dr. Feinauer. You're working hard, you're making good money, but you feel like you can't get off the treadmill or the income goes away very quickly. And so you're here at this webinar going, how can I be less like Christian and more like Murray? And that's what this webinar is all about. All right. But the truth is, even if real estate is right for you, it's not all right for you. The likelihood that you want to invest all the way across the real estate investing continuum is very low. So this is what we call the spectrum or their continuum. You'll see on the left side of your screen here, this is the more active side, the more direct side. And on the right side, you have the more passive side. Okay. And as you move left to right, you see yourself moving from ground up construction, where you're actually building the property and then putting tenants in it and managing it, et cetera, to fix and flips, short-term and long-term rentals, turnkey properties where you still own the whole property, but you've got somebody managing every aspect of it, to syndicated properties and private funds, which usually contain 10 or 15 syndicated properties, and REITs, which tend to be a little bit bigger, these real estate investment trusts, which can sometimes get so big that they go public and they become publicly traded REITs available on the stock market. And you can actually buy mutual funds or even index funds that hold all of the REITs in the public stock market. So as you move across that spectrum, you see that there are some benefits, right? As you move from left to right, but there are also some downsides, right? As you move left to right, you need less experience, less expertise. You also have less hassle, and your portfolio is more easy to diversify. You also typically gain liquidity, but you lose control over the investments. You also lose tax benefits. You often pay more fees. And because you're doing less and paying somebody else to do more, your returns often go down as well. So, what is a real estate education and where can you get it? Well, there's a certain amount of stuff you need to know to be an effective real estate investor. You've got to be able to talk the talk. You've got to know the vocabulary of real estate investing. At some point, you've got to put together a basic framework of how it works, and then additional information you can place appropriate places on the framework. And so I think the best place to start are books and online courses. They're great for providing a basic framework, or depending on the book or online course, delving into a niche subject matter a little bit more fully. However, what they're not as good at is staying up to date on the latest and greatest. If you want that, blogs and podcasts tend to be the way to go. We've talked about real estate investing intermittently for the last decade on the White Coat Investor blog and podcast. The other benefit of that is it tends to provide a little bit more inspiration. You can do this rah a bit, and and keeping you going over time toward your financial plan. If you have more personalized questions and controversial topics, things for which there is not necessarily a correct answer, there's another place where you can get that education, and that's forums or communities such as Facebook groups, and especially mentors, people that have been down the path you want to go down. And that's a great place for those personalized issues or topics where you just want a multitude of opinions on them. Okay. Real estate, as I mentioned, has its own vocabulary. You got to learn this stuff, or it's just like you have no idea what's going on, and people are talking around you, and you're ripe for those scammers that are out there in the real estate space to take advantage of you. For example, what is a capitalization rate? Why does it matter? You got to know this stuff. How do you calculate a net operating income or an equity multiple, right? These new terms, if you've never understood these, if you've never read about these, then when people throw them out there, you're not going to understand what they're talking about. And that's going to keep you from being able to effectively evaluate an investment. How about what are the different types of catch ups in a waterfall? Maybe you don't even know what a waterfall is. This tends to be the way that a manager gets paid in a syndication or a private real estate fund. It's the way the profits are split up between the investors and the operator. Perhaps you're wondering what's an appropriate price to pay a live-in apartment manager versus a property management company. Is one of them cheaper than the other? How much is too much? How much is not enough? How about this one? What items need to be in a short-term rental, right? You probably rented a few Airbnbs or Verbos, but how'd they decide what to actually leave in the apartment, leave in the condo, leave in the beach house for you? What's expected to be there? What's not expected to be there? Okay, you got to learn these things. How about which types of renovations will provide the best bang for your buck in a fix and flip? You got limited money. You want to still have a profit left at the end. Should you replace the garage door or should you replace the kitchen flooring? Which one's likely to provide the best bang for your buck? How about this one? There's been a lot of discussion about this in the WCI community. How do you determine market rent? And should you charge it? Right? Okay, let's talk a little bit about leverage. When we're talking about leverage, we're talking about debt. Okay, that terrible D word, right? Many of us got very used to debt while we were in medical school and lived essentially completely on debt, and then had a debt of $200,000 or $300,000 hanging over our heads for a few years afterward. But when you or your representative buys a property for you using borrowed money, you're using leverage. Okay, and that's known in the stock world as investing on margin. Has the same effect in the real estate world. It increases risk, but also increases potential returns. It does work, but it works both ways. So let me use an example here. Let's say you got a couple $100,000 that you want to invest in real estate. So option number one is to buy a $200,000 condo with cash. Let's say it pays you $10,000 a year for 5 years and appreciates 25%, just to keep it simple. You then sell the condo. You pay perhaps 6% in closing costs. You walk away with $266,200. That's a cumulative return of 42.5%, which annualizes out to about 7.3% per year. Or instead, you employ leverage. You use your $200,000 to buy 4 similar condos. Your cash flow at this point, because you got these mortgages on these 4 condos, your cash flow is barely covering your expenses, but they appreciate 25%. Then you sell them, paying 6% in closing costs again and paying off the remaining mortgages. Perhaps you walk away with $360,000. That's a cumulative return of 80%, which annualizes out to 13% per year. Okay, that additional 5.7% is the effect of leverage. So leverage is good, right? Well, not necessarily. Investing is far more about controlling risk than it is about seeking out returns. And once you realize that, most of your focus will be on how much risk do I need to take to reach my goals. But it's interesting. If you look at the ratios of the borrowed money to your money, when you put 25% down, you're basically using $3 of other people's money for every $1 of yours. If you put a third of the money down as a down payment, you're using $2 of other people's money for every dollar of yours. But if you only put 5% down, you're now using $19 of other people's money for every $1 of yours. It does not take much to wipe out all of your money and then some. For example, if you're only 5% down and the value of the property drops 10%, not only have you lost all of your money, you've lost that much more money again. So you need to consider worst case scenarios. What will you do if the property values crash or the rents decline or both? How long can you really ride it out? And it turns out that the key is to be cash flow positive, meaning that the property is paying you cash after all the expenses, after all the repairs, after all the vacancies, you're still getting cash from the property. Because if you have cash flow properties, cash flow positive properties, you can have an infinite number of those. But if you have cash flow negative properties that you're actually having to feed every month, even on a doctor income, you can only carry so many of those before you end up in bankruptcy. So, what's the key? Well, typically you need to put down between a quarter and 1/3 in order to stay cash flow positive. And you'll see that most professional investors stay between a loan to value ratio of 50 to 75%. And that tends to be the sweet spot where you're getting the benefits of leverage, but you're also okay in a market downturn. Nobody likes a market downturn, but at least you can ride it out the 5 or 10 years it might take for your property value to recover, because you're able to have cash flow that allows you to stay in the game long enough for the property to recover. All right, let's turn the table a little bit and talk about some issues that lots of white coat investors have had. And this is what I call the dilemma of the minimum investment. If you want to go buy properties, now maybe if you're in some rural county in Tennessee or North Dakota, maybe you can go buy properties with less. But for the most part, you're going to need somewhere between $50,000 and $200,000 to go buy an investment property. And some docs have this money and some don't. If you don't have it, there are some options. You can do some house hacking. You buy a duplex or something, rent out one side and live in the other side. You can create some sweat equity, buy a fixer-upper and put your work into it instead of your money. You can find some partners to provide the cash and then split the profits with them in some way. Or you can do what most of us do, which is save up some money, carve it out of our income until we have the money to invest. You'll also find on the passive side that real estate investments tend to have minimums, and they can range from relatively low, $5,000, to relatively high, $1 million. The dilemma, though, is that the more experienced managers tend to have higher minimum investments. And when the investment minimums are higher, it makes it a lot harder to maintain diversification in your portfolio. Let me give you an example. Let's say you have $1 million portfolio. You're a millionaire. Congratulations. And you've decided that you're going to invest 1/3 of it into real estate. And your preferred place on the real estate continuum is syndications. For example, apartment buildings that you go into with 99 other people and you buy it. They tend to have, $100,000 minimum investment. So if you've got $1 million portfolio, $333,000 of it in real estate, you can buy 3 of those properties and you have $33,000 left in cash. But if one of those 3 deals goes south, you could lose 10% of your portfolio. Plus, let's say you're a doctor and you've got a pretty good savings rate. You're saving $100,000 a year, and 1/3 of that's going toward real estate. That means just to save up for your next syndication, it takes 3 years, right? It's a real dilemma, these minimum investments. So there are some options to diversify with lower minimums. Let's just take a look at the current WCI advertiser list. These are all the folks advertising with us currently. And I've listed them in order of their minimum investments. At the top, you can see Fundrise. They have a REIT that you can get into with as little as $500. I mean, you can get into real estate investing for even less in the publicly traded markets. You can buy a share of VNQ, which is Vanguard's real estate index ETF, for $90. But you're going to have at least that to get into real estate investing. As you move, however, into these more private real estate investments that tend to require you to be an accredited investor, you'll see minimums of about $5,000 across what I call the crowdfunding platforms like Realty Mogul. It's been around for a long time. They have some REITs that you can get into for $5,000. If you want to invest in their syndications, the minimums tend to be higher. Acre Trader, if you want to buy some farmland syndications, they also can be as low as $5,000. Equity Multiple, again, as low as $5,000, although you'll see a lot of them are higher at $10,000 or $20,000. The Peak Housing REIT, which allows you to invest in hundreds of individual single-family homes, you can get into with as little as $25,000. Origin's investment fund minimum is $50,000. Same with Welling's Capital Fund and the MLG. Their MLG Capital is raising money for their Fund 6 right now. Their minimum, $50,000. The Mortar Group, their syndications also have minimums of $50,000. So you move over to 37th Parallel. They offer funds as well as syndications. Minimums are $100,000. Jack's Wealth Investments Fund, they've got a fund with a $100,000 minimum, or they also offer turnkey investments, where you buy an entire house. So depending on how much you put down and how much the house goes for, that's probably $100,000 or more in order to buy that. DLP Capital has their minimums up to $200,000 now. In fact, it's been $200,000 for white coat investors now for some time. They actually lowered it for everybody to $200,000. It used to be $500,000 for most people to get into those funds. And it just takes a certain amount of capital in order to make those investments and still have a diversified portfolio. So this dilemma does get better as time goes on. As you earn more, if you're a fancy pants private practice ENT surgeon making $800,000, this dilemma isn't nearly as big a deal as if you're a pediatrician making $205,000 and only 2 years out of residency. The requirement for most of these is that you be an accredited investor. And what that means, technically, is that you have either a $200,000 income for each of the last couple of years or a $1 million portfolio, $1 million in investable assets. I really don't think that's enough, to be honest with you. I think a better guideline is to have an income twice that high and a portfolio twice that big. Because if you don't, chances are you're not going to be diversified for a while. And there's some risks there. As I mentioned, I've had one syndication that's probably going to be a complete loss. And imagine that was, half of your real estate portfolio. That would be a pretty big deal. So I encourage people before they get into any investment that requires them to be an accredited investor to be a real accredited investor. And what that means is two things. One, that you can lose your entire investment without it affecting your life financially in any way. And two, that you can actually evaluate the merits of the investment without the assistance of an advisor. Now, we all start somewhere and we learn as we go along. But if you feel like you've got to call up your attorney and your accountant and your financial advisor before you can make an investment into one of these, you're probably not a real accredited investor yet. All right, let me introduce you to our real estate investing course. This is the No Hype Real Estate Investing course, and you can get more information at whitecoatinvestor.com/nohype. We had more than a dozen faculty members in this course. It's more than 25 hours of content. It covers the entire real estate spectrum, this entire continuum, everything from, the very active stuff, short-term rentals, fix and flips, turnkey investing, to the more passive stuff, syndications and funds and REITs, and even investing in publicly traded real estate. It assumes no previous knowledge, but it still covers topics in depth. You'd be surprised occasionally we still get way out into the weeds, even though we start with explaining all the terms. The emphasis in the course, though, is on straightforward, tell it like it is, no hype education. And that's because we found that's what white coat investors want. They just want to be told how stuff works. They're smart people. They don't need to be motivated. They certainly don't need to be lied to. There's lots of real estate gurus, webinars, courses, books, etc. out there where people are telling falsehoods. The story with real estate is good enough. It doesn't need to be embellished, right? The stuff works. So I think we can just give it to you without any of that hype. But we include practical tips for every type of real estate investing. And there's even a pre and post test to test your knowledge should you want to take it. I mean, I guess you don't have to. It's your course. The cool thing about it, though, is exactly that. It's your course. It's evergreen. You can buy this anytime you like. Yeah, it's on sale through September 26th, but it's going to be available even after that, right? You can buy it at any time. You don't have to wait until a cohort is ready to go through it. You don't have to wait until it goes on sale once or twice a year. We wanted a course that when you're ready to learn about real estate, you can take the course and learn about real estate. It's available to you indefinitely after you buy it. So if you want to buy it now and not even start it for a month, you can do that. If you want to take it all in a week, you can do that. If you want to take it over 6 months, you can do that. Whatever your own pace is. In fact, you can even listen to it podcast style in your car using the Teachable app if you have an Apple phone, an iPhone. So here, what's in the course? Well, the first module is an introduction to the course. And then the second module, we get into your why. We talk about your goals, why you're interested in doing real estate and what you're looking for. It's really important to start from the beginning at that 30,000 foot level so you know exactly why you're doing this as you move through it. Then the third module is pretty good length. It gets into the vocabulary of real estate and a lot of calculations. You learn how to calculate your gross scheduled income and your net operating income, and calculate an internal rate of return and an equity multiple, and coverage ratios, and all these terms that you need to know in real estate. And we walk you through those calculations and show you how to do them. The good news is most of them only require about fifth grade math. If you can do addition, subtraction, multiplication, division, you can do the vast majority of real estate calculations. And the rest of them, you can use a financial calculator or a spreadsheet to do them. And we show you how to do that in the course. The next module is all about finding the money to invest in real estate. The minimums are not insignificant, even for white coat investors. And so we teach you how to find that money, where it can come from, and what options you have. In the fifth one, we introduce you in depth to the real estate spectrum, go all the way across it and talk about each of the issues and try to help you find where you fit on it. There's lots of people that just want to be in total control of every aspect of the investment. And then there's people like me that are busy. We're busy canyoneering. We're busy practicing medicine. We're busy running the white coat investor. And we invest far more passively than lots of other real estate investors. But the key is to be where you need to be, where you want to be, where your interest lies, the amount of hassle you're willing to deal with, the amount of control you want, the return you seek, and to get you into the right place on that real estate spectrum. It might be the most important aspect of the decisions you make as you go into real estate. You're just not going to be happy if you decide I'm going to own and manage a 28-unit apartment building myself, and then you start neglecting it because you didn't want to put in that much energy and work and hassle and have those direct interactions with tenants. You're going to be miserable. Even if the investment's great, you're going to be miserable. You would have been far better off in a syndication or a fund or something like that. All right. The sixth module, we talk all about retirement accounts and how they interact with real estate, which ones you can invest in real estate and how, whether you should or shouldn't, whether you should take money out of retirement accounts, whether you should borrow against them, whether you should use self-directed retirement accounts. And we also talk about how to own real estate, whether it ought to be an LLC or a corporation or a partnership or tenants by the entirety or all these different ownership structures, and which ones are most favorable for you to own them in. Okay, then as we get into module 7, we hone down into different sectors of that real estate continuum. We spend a whole module on publicly traded real estate. There's a lot of publicly traded real estate out there. Has a lot of pros and cons that you need to know about if you're investing in that. The next module is private real estate funds, where we talk all about how to find a good, experienced manager that's charging you a fair price and giving you good service. The ninth module is all about syndications, buying one property together with other investors, and having that managed for a number of years before selling it. The 10th module is all about turnkey properties, where you own the whole property, but you don't do anything for it. No buying, no selling, no managing, etc. You've got somebody else to take care of all that stuff. In 11, this is a lengthy module. We get into long-term rentals, the traditional mom and pop landlord situation. We talk about everything from how to market the property, how to select the property, how to manage the property, how to screen the tenants, how to hire management for it, how to get insurance for it, how to deal with the taxes on it, etc. All of that for long-term rentals. Then we do it again in module 12 for short-term rentals. This is a game that a lot of people have gotten into lately with some fantastic results. In the right area, short-term rentals do very, very well. And so we teach you how to do short-term rentals. The 13th module is all about fix and flip properties. If you really want to get active with your real estate investments and you want to get out there and find properties, fix them up, and then sell them, a few weeks or a few months later, we'll give you some tips on how to do that as well. Module 14 is another lengthy module where we talk about the tax benefits of real estate investing. Whether you want to hire out, the actual tax preparation or do it yourself, we're going to go through everything. We're going to go through the K-1 forms. We're going to go through Schedule E. We're going to go through, real estate professional status. We're going to go through 1031 and 721 exchanges. We go through all the tax benefits of real estate investing so that you understand them completely. 15th module is all about how to title your real estate, as well as some unique asset protection aspects of real estate that you should be aware of. In the 16th module, we introduce you to resources. These include resources we have here at the White Coat Investor, as well as resources that we have with some of our blog partners and other people out there that have courses and other services that they provide, and also a number of our sponsors and advertisers that we introduce you to in the course. And so you get a chance to get to know them. A lot of them actually provided some resources in the course and served as faculty. And so here's a chance to get to know what they do professionally. If you're looking for somebody to invest with, if you're looking for the good guys in investing, we'll introduce you to a whole bunch of them. 17 is the end. You get a post test and a little bit of wrap up material. But that's the course. It covers the whole real estate continuum, soup to nuts. All right. The price on the course is $2,199, but it's $400 off till next week, till September 26th. It's currently $1,799. I know it's a lot of money, but it is an investment in your ability to invest effectively in this asset class. And I'm confident that that will produce an incredible value for you over the years. That may produce a value 100 times that high for you to actually learn this information right at the beginning as you get into real estate investing. But in case you're not sure, we're offering it at no risk to you. As usual with our courses, you get a 1 week, no questions asked, money back guarantee. As long as you've watched less than 20% of it. Don't watch the whole thing in 5 days and then call us and ask for your money back. We'll actually check to make sure you've watched less than 20% of it. But you can check this thing out. We want you to check it out because we know very few of you actually take us up on this guarantee. Traditionally, it's been like 3% of students that take us up on the guarantee. And so we know that most people are very happy with what they've gotten. And because those who aren't happy get their money back, nobody ever complains about it. Information, again, whitecodeinvestor.com/no-hype. We have other real estate resources you should know about. The WCI blog and podcast are totally free to you. We cover real estate topics periodically. We've been doing a lot this month. Obviously, we're promoting our brand new course, so we're doing lots of real estate the last couple of weeks. We also have a free monthly real estate newsletter. If you signed up via email for this webinar, we also signed you up for that newsletter. You can unsubscribe anytime you want. But we send out once a month some real estate education, as well as introduce you to our partners and any special deals on courses coming up, that sort of a thing. We have a list of real estate partners. If you go to whitecodeinvestor.com, you can go under the recommended tab. You can scroll down to real estate companies and you can see our current partners there. We have partner sites that we partner with over at Passive Income MD or Semi-Retired MD. They occasionally open their courses up and can teach you about specific areas of real estate investing as well. And then, of course, we have a conference. We'll actually be registering for that coming up October 10th at 7 p.m. Mountain Time, WCICon 23. It's going to be in Phoenix. It's going to be great. It's the first week of March. It's not all real estate focus. It's called the Physician Wellness and Financial Literacy Conference, but there's always some real estate material there as well. All right. So we're going to get into your questions. You can submit your questions, whether they're about the course, whether they're about real estate in general. You can submit them as a comment on your platform, whether you're on Twitter, whether you're on Facebook, whether you're on YouTube. And we'll get as many of those answered as we can. If you have some private questions about the course that you don't want to ask here, or we don't get to your question, you can email courses@whitecodeinvestor.com. If you have private questions about anything, you can just email me, editor@whitecodeinvestor.com. I'll try to get back to you within a week or so. So far, I've been pretty successful at doing that over the years. But I think Katie's going to start moderating questions for me. So let's pull this down here and start doing what we've got. All right, so we got our first question. This one's coming in from Michael Hoffman. He's asking what proportion of the course focuses on passive versus more active real estate investing. Well, like I said, it goes all the way across the spectrum, soup to nuts. So we've got a module on fix and flips. We've got a module on short-term rentals and long-term rentals. We've also got an entire module on syndications, entire module on passive funds or private funds. We've got an entire module on publicly traded real estate. So I'd say it's split. It's probably 50-50, active and passive. So this provides a broad education for you. The focus is on learning all about real estate rather than necessarily niching down into one specific area of it. Hope that's helpful, Michael. All right. This question from B. Whalen. Would you recommend getting involved in real estate investing while still paying off student loan debt? Well, this is one of those things, right? I want you to have a plan for your student loans. Maybe your plan is public service loan forgiveness, right? You're working for an academic institution, and you only did a 3-year residency. So you got 7 years more before those loans are going to be forgiven. I don't think you ought to wait 7 years before you start investing. So I think it's okay to invest while you're working that plan. Maybe you're paying off your student loans, and maybe you got a plan to pay them off really aggressively. Maybe you want to have them gone in 18 months. If that's your plan, most of your money during those 18 months is probably going to be going toward the loans rather than investing. But maybe your plan's 4 or 5 years, in which case a significant chunk of your money is going to be going toward investing. So I find that most people really don't want to have their student loans hanging around much longer than about 5 years. There's always a few exceptions, people that want to drag it out forever. My neighbor's got his loans at 0.9%, like everybody else that graduated in 2003. He's dragging them around. I think he's still got $15,000 or something. But for the most part, I think it's okay, as long as you're following your student loan plan, to invest the rest according to whatever your written investment plan says. And if your plan says 80% invested in real estate, that's fine. If it says, like mine, 20% invested in real estate, that's fine too. But yeah, I don't think your loans have to be completely gone before you start investing. I just want to see you, during especially those live like a resident years, to really be dedicating a large percentage of your wealth, of your income, going toward building wealth, whether it's paying off debt or whether it is, investing. Okay, Jim, I want to, just from Andrew Brooks, thanks for the question. I want to enjoy my real estate investment. How do you factor in residency? I'm not sure what you mean by enjoy it, right? There are some people that go into real estate investing because they feel passionate about providing housing for people, but they're a minority. Most people are about the money when they're investing in real estate. It's not, something they really enjoy a lot. It's kind of fun to drive by and say, I own that. Maybe it's fun to do a little bit of work in something that's not medicine, whether that's managing or maintaining the property. But for the most part, if you're looking for a property that you're going to enjoy, there's a good chance it's not actually a good investment. Lots of people go out and buy something. They're like, well, I'll rent it out the weeks I'm not there, but they end up buying it primarily as a consumption item and hope it just offsets some of the costs for that. So I recommend against those sorts of investments. Just go buy the place you want to consume and then keep your investing separate. How do you factor in residency? Well, it's pretty hard to do anything other than sleep when you're not at the hospital during residency, in my experience. So, I know a few people that have successfully, home hacked, house hacked during residency. They bought a house, they rented out 3 rooms to other residents, and they rent out the couch to visiting medical students, and they actually did okay. Maybe they stayed in that area after residency and did fine on the investment. But for the most part, most people are probably better off renting during residency, quite honestly. And so, the truth is, you're not going to get rich for what you're doing during residency. Put off most of your investing until you start making that attending income. That includes real estate investing. All right, another question from Michael. Would the course be beneficial for more experienced real estate investor? And if so, how? I think so. If you know everything about real estate investing, obviously this isn't going to help. But we offer a no money back guarantee. You can go check it out. If you find, oh, it's all too superficial, I know all this stuff, ask for your money back. We'll give you your money back. But I got into the weeds in a lot of topics, how much leverage you should be using, all the various calculations that you do with it, how to evaluate syndications and managers, and how to build a portfolio with real estate. It gets into the weeds in a lot of places. So I think even though you may already know half the stuff in the course, I think you're going to find stuff in there that's still of value, even if you've been doing real estate investing for quite a while. All right, this one from Kamal. Thanks for the question. Does the Evergreen online course ever get updated with updates to all people who have bought it? So if laws change or other things come up with time, we get those updates. Yes. The plan is that you buy it once and you get anything else we put in it for free. And the plan is actually for it to grow and live, right? We hope to add stuff to it each year, whether that's material that's new with laws, new with regulations, new ideas, new ways of investing, or material from some of the conferences we do. We expect we'll be adding material from WCI Con each year to the course, and you'll get that for free. In fact, this is brand new. Right. So we don't have testimonials yet on it. We haven't gotten much feedback from you yet. And I'm sure as people take the course, they're going to see things that they like about it, see things that they're like, oh, I wish there was more of this in it. Can you beef up the fix and flip section? And so as we get that feedback, we're going to add stuff to the course. And that, of course, will be included in your price. This isn't a subscription model where you got to pay each month for it. Once you buy it, it's yours. And as we add stuff to it, that's going to be yours too. And so, yeah, that's the plan with the course. Is there CME for the course? Is Martin's question. Right now, it does not qualify for CME. This is all hardcore real estate information. There is no fluff in it. There is nothing that's going to help your clinical practice other than making you financially independent, which I personally believe makes you a much more capable partner, parent, and physician. But it's no CME for now. We are looking at ways that potentially maybe down the road we can add CME to it, or offer it free if you buy a specific CME course or something like that. But right now, there is no CME in the course. Okay, this one from someone on Facebook. Could you please elaborate on leverage? We have few rentals and would like to know at what time to start paying off. Thank you. This is a great philosophical discussion. When should you pay off your rentals? And there are a lot of people that like to go into retirement without debt of any kind. That's their goal. We just want to pay them off by retirement. For example, I mentioned my friend Murray that I showed in the canyon back there. He's got almost all of his paid off. He's never had a loan longer than 7 years on a property. So he buys them, and his plan is to pay them off pretty quickly and then buy another one. And that's fine. But the truth is, if you maintain a certain amount of leverage, 50 to 75% loan to values, you're likely to build wealth faster. So if you are in the point where you're trying to really build wealth, where you're trying to accumulate a certain number of doors under management or build a nest egg of a certain size, you may want to continue to employ leverage. If you're at the point where I kind of want to minimize my hassle, minimize my risk, these are kicking off enough income for me, especially if I didn't have to pay mortgages, well, maybe you're at the stage where you want to deleverage a little bit. So some people actually carry that debt into retirement, and some people have it paid off long before retirement. There's a huge variation here. There's not really a right or a wrong answer. If you're starting to get nervous about it, it might be time to, instead of buying another rental, put that money toward paying off the loans. The nice thing about debt is exactly what your return is going to be when you pay it off. It's the after-tax interest rate on the debt. If you've got 5% debt on it, and let's say it's deductible, and you're in the, let's say you're at 40% marginal tax rate, you're going to earn a guaranteed 3% by paying off that mortgage. And if that's an attractive investment for you at this stage of your life, then pay it off. If it's not, well, maybe you let that ride and you use the money instead to invest in index funds, or to invest in another real estate property, or to buy a syndication or whatever. Okay. Next question from Adib. Thank you for the question. Could the course be enough for a beginner to start investing in long-term rental properties? Yes, absolutely. It is not going to take you by the hand and call you up each week and check and make sure, hey, did you look at 5 properties this week to buy? I'm not going to take you by the hand and do that. I'm not going to have office hours every 2 days and for you to come in and report on your progress or anything like that. But I'm certainly going to give you all the information you need to go out to buy, manage, and get a long-term rental property and start doing it properly. So yeah, I think the course is enough. If you need additional information, we'll point you to resources that can give you more information after that. Okay, this one from Paul. Can you give more detail on what went wrong with the syndication that is likely to be a complete loss? I can give some vague detail. There'll be a blog post about it at some point when it all wraps up. But as you know, when things go bad, they also drag out in time. And so this was a syndication that was supposed to be wrapped up 2 years ago. It's probably going to be another 2 or 3 years before it really wraps up. But the bottom line is, the operator, against the operating agreement that said he had to have the agreement of all the investors in the deal in order to take on more leverage, went behind our back and borrowed additional money against the property, as well as all of his other properties, in order to ramp up his leverage on this real estate empire he was building. And it all collapsed. The house of cards came down. He went bankrupt. And of course, when he has no money, there's nobody to go after for the money. And so it's likely to be a total loss. All the principal has probably been used up. It was a value add investment where they were trying to fix up this apartment building, and it hasn't had a reasonable occupancy rate for the last 3 or 4 years. So I don't think there's any of that money left, but you never know for sure. I've already gotten a K1 that shows my entire investment lost. So I expect that's where it's going to end up. But there'll be a blog post about it when it finally wraps up. Okay. Do you dive into the tax implications, benefits of real estate for high income professionals in incredible depth? Yes, we do a lot on taxes in this course. In fact, I think this is one of the biggest strengths of the course, in that I don't know of anybody else that gets into the tax stuff in as much depth as we have in this course. Everything from exchanges to how to fill out Schedule E, how to, evaluate your K1s, what to expect for filing in multiple states if you invest in a bunch of syndications or funds, all kinds of tax subjects that you would be interested in. All the various deductions you can have with direct real estate investing. How much depreciation, what depreciation actually looks like when you get your K1s, and that sort of stuff. All right, this one from Justin. For non-accredited investors, what is the best way to get in passive real estate investment that has tax benefit? Well, you've got a few options when you're non-accredited. One of the best ones is publicly traded real estate. You don't have to be accredited to invest in publicly traded REITs. You don't have to be accredited to invest in things like the Vanguard REIT mutual fund. You can do that without any significant level of wealth, and it's very, very passive. And you do get some tax benefits, in that some of the return from that, some of the income that comes from it, is sheltered by depreciation. And in a REIT, the way that looks is it's a return of capital, is how they characterize that money. But that's essentially them just passing through depreciation to you. From now until 2025, that income is also eligible for the 199A deduction. So basically 20% of it is not taxable either. So that also helps. Of course, for most non-accredited investors, they have a pretty high ratio of tax protected investment money to taxable money. They've got Roth IRAs, 401ks, et cetera. And we show you in the course how you can invest in real estate using those types of accounts to invest in passive real estate. If you want to get into the more private stuff, there are some that allow it. Some of the REITs, I think Fundrise, and I think Realty Moguls REITs do not require you to be an accredited investor in order to invest in those. And then, of course, if you're interested in more direct real estate investing, you can go buy property without being an accredited investor. It just can be hard to come up with the money. Okay, this one from Veer Singh. Can I have a moment of solidarity for those of us who, after med school residency fellowship, are absolutely daunted by the fact that it's time to learn another language, and your thoughts about the learning curve? You're right. There's another language just learning about finance, period. Learning personal finance, learning investing, learning expense ratios, and, stocks and bonds and dividends and Roth IRAs and, deductions versus credits and all that kind of stuff. And then real estate kind of adds another level on top of that. And I'm sorry about that. The good news is this stuff's all way easier to learn than pulmonology or nephrology. If you think about just the time you spent on pulmonology and nephrology as a second year medical student, you can learn everything about real estate in less time than it took you to learn those two subjects in medical school. So is the learning curve steep? Yes, but I don't think it's that tall. You can do this. If you're interested in it, you can do it. I think this course can help you immensely. Like I said, it's a 25-hour course, and you will come out of it being able to speak the language of real estate. All right. This question from Phil Cool. Thank you for the question. Owning both a short-term and long-term rental property, the concepts are fairly simple. However, finding a profitable property is always the challenge, especially now. Any recommendations on deal finding with all of the competition? Boy, isn't that the challenge, right? One benefit of seeing your home appreciate 50% over the last 2 or 3 years, or one downside of that rather, is that it's really hard to find awesome deals on real estate like you were able to find in, 2009, 2010, 2011. We bought the house we're in 2010. There was nobody buying houses. I looked at every house for sale within 2 miles of this house. There was 30 of them. I checked back with them 6 months after we bought this one. 29 of them didn't sell. We were the only people buying at the time. When you're in that sort of a situation, of course you're going to get a good deal. You're going to end up with an incredible long-term investment. But the truth is, when you're a long-term investor, you can buy just about any time, and it's going to work out in the long run. This is particularly true in the short-term rental property market. The truth is, when you are buying a short-term rental property, it tends to be a pretty desirable place. A lot of times it's somebody's second home, or it's already in use as a short-term rental property. You're in Telluride, you're in Park City, you're in a beach city, and these properties don't become distressed, because when people get in trouble, the first thing they sell is their second home. The last thing they sell is their primary home. And so you typically don't get a great deal on short-term rental properties as far as buying them. It's the management of them that enables you to make a lot of money doing that. So I guess I would caution you against looking to get a screaming deal on something that you're planning to use for a short-term rental. Now, obviously, long-term is not typically as profitable when it comes down to it. And so it's good to get a deal. But there are always people looking to get out of their rentals. They are sick of the game, or they just, unfortunately died, and their heirs don't want to manage these properties and are now looking to sell them, especially now that they get a step up in basis. So there are still people that, are motivated sellers, even in today's market. And especially if you have to use a lot of leverage, with these rising interest rates, it's certainly squeezing some people out of the market that aren't able to buy as much or aren't able to buy at all because interest rates have gone up. If that doesn't matter to you because you're a cash buyer, you may find some real deals. Over the last month or two, housing prices have started to drop in a few places in the country. And it may be that a year or two from now, it becomes one of those great times to buy real estate again. So if you can't find a deal that's good enough for you, don't buy it. Give it some time. Wait, right? But in general, I think just buying regularly throughout your investing career, some years you're going to get a better deal than others, is probably the best way to do it, just like you would invest in stocks. Okay, are your syndications earning more than your stock and bond portfolio? Well, remember, my particular asset allocation is 60% stocks, 20% bonds, and 20% real estate. So, am I making more money in real estate with 20% of my portfolio than I am with 80% of my portfolio? Probably not. Do I tend to have higher returns? Yes, I do tend to have higher returns. If it's a really good year in the stock market, my stocks make 25%, I probably did better in stocks than real estate that year. But in general, real estate is more leveraged than stocks. And so it tends to have higher returns. And, if I'm going to give up liquidity, if I'm going to tie my money up for a year or 2 or 5 years, I expect higher returns out of that. I expect an illiquidity bonus, an illiquidity premium, if you will. So if I don't expect to earn 10, 11, 12, 13, 14, 15% on, a private real estate investment, I might as well just put that money into, publicly real estate or just the stock market in general, and earn, 7, 8, 10%, something like that. So I hope that's helpful. All right, next question from someone on Facebook. Do you cover in depth how to do vetting for syndication deals? Yeah, that's module 9, I think it is. It's all about vetting syndication deals. Module 8 is more about the manager, right? Which is the most important part of both a syndication as well as a fund, because a manager can, make lemons out of lemonade if it ends up not being an awesome deal. But a crummy manager can ruin even a good deal. And so it's important to do vetting, and it's important to vet the manager, but also the deal. And we cover both of those. There's a module on each of them, really. So quite a bit of extensive coverage there. All right. So Young has a question. What's the lowest risk entry type of active management real estate? The lowest risk entry type. Well, one risk you can eliminate is leverage, right? If you go into something and you buy it with cash, you've eliminated a lot of your risk right there. You probably lowered your return as well, but you've lowered your risk. So that's one way to do it. One nice thing about a turnkey property is that oftentimes you buy it. In fact, you don't even have to buy it. You hire somebody to buy it, essentially. And there's a tenant already in it. So you've already got a pretty good expectation of what the income is going to be, et cetera. Another area that's pretty attractive to people looking for low risk, low hassle investments is what's called a triple net property. And these tend to be, a industrial property or a retail property, some sort of commercial real estate. And it's triple net, meaning it's net of, your taxes and insurance and expenses. So the tenant has to pay all that, their maintenance and all that. And all you have to cover is the mortgage. And so that's a pretty low risk way to invest. You can see pretty easily what your income is going to be and what your expenses are. And they tend to be long-term contracts as well. So if you're really looking for active, but still low risk, you might want to check that out. All right, this one from someone on Facebook. How is the no hype program the same, different from the passive income by real estate course or program? So we're talking about passive income MD Peter Kim's course, PREA, that we've sold here at the White Coat Investor for a number of years. Passive income MD is one of our partner sites. We work closely with Peter in a lot of different things. So obviously there's going to be some overlap. We talk about passive real estate investing in our course, and so there's going to be some overlap of the material there. Some of the things we don't have that Peter does have. Peter's course is cohorted, so you can buy ours anytime. It's evergreen, but you go through his course in a cohort. They're 2 times a year. You can enroll and go through the course together with other people. There are more live components in his course. And then he plugs you into the passive income MD community as you take the course as well. So those are the primary benefits of PREA. On the other hand, we sell our course for a little bit less money, and it includes a lot more material about active real estate investing, as well as taxes and all that other stuff, because we try to go soup to nuts all the way across the real estate continuum. Hope that's helpful. What is your goal ROI across the spectrum of investing? From Wesley. That's a great question. My goal ROI. You know, I like to earn what the market gives me. And whether that's stocks, whether that's real estate, et cetera, I try to expose myself to those factors of investing that will likely provide a long-term investment return that will exceed inflation and reach my financial goals. So rather than saying, I got to make 11%, I say, what's the market giving this year? Because if the market's given 25%, I want to make 25%. If the market loses 5%, I'm probably content to lose 5%. And so my goal is to get the market return out of real estate, whatever type of real estate that is, according to how much leverage I've taken on it. So if we're looking at like debt real estate, we're talking about investing in funds that loan money to developers, for example. You'll see that that typical yields out of those funds range anywhere from about 7% to 11%. So if that's what I'm investing in, that's my goal. I'm trying to get 9, 10% out of that. If I'm investing in a reasonably leveraged, equity mutual fund, they're probably aiming at 12 or 13% is probably what they're aiming at. And so I hope they not only meet that, but maybe beat it. Maybe get me 14 or 15%. But if I am actually going to the trouble to buy the property myself, manage the property myself, and invest directly, I would hope that I could make more on that, because part of the return is the time and effort I'm putting into the property, and I want to be paid for that. And so I'd like to see something a little bit higher if I'm actively actually out there doing it. And if you're doing all the work, if you're doing a fix and flip, I think some of the guidelines are that, you basically need to buy the property for less than 2/3 of what you expect to sell it for later. Okay, next question. S2K fan 1. All right. Regarding tax benefits for high income earners, does this course cover anything other than reps for spouses of working physicians? Yeah, we cover all kinds of stuff. We cover exchanges. We cover how the income is treated. Whether it's earned income, et cetera. We show some tricks of how you can hire your kids to work in the property and actually take that money, pay no payroll taxes on it, pay no income taxes on it, and have it grow forever tax free after that. We do cover reps, as you mentioned. We cover 1031 and 721 exchanges. We cover the tax benefits of REITs. We talk about the 199A deduction. We show you how to fill out tax forms. We talk about the various types of depreciation, how you can accelerate them. We talk about, segregation studies and how you can use that to increase the amount of depreciation you get. So yeah, we cover a lot of tax in depth. The course covers a lot of tax stuff. All right, this one from Daniel. For someone who currently owns a single family home as an investment property making positive cash flow, would you recommend a cashback refinance HELOC given the crazy appreciation over the past 2 years to use for future real estate investments or to use towards my med school debt? Thank you. Okay, well, 2 questions here. One is, do you borrow money out of the property? And the second one is, what do you use that money for? Well, let's address the first one first. I talked about what I think is a reasonable amount of leverage, and that's enough that you stay cash flow positive. So how much more can you borrow out and still be cash flow positive? I think that amount's okay to take out if you're still trying to meet your, investment goals. I think that's fine, right? Let's say you put down 25% initially and things appreciated 50%. Well, there's quite a bit of money there you can now take out and still be at your original, 75% loan to value ratio. And I think that's okay to take out. Would I take a huge chunk of it out that now if property values drop 40%, you're going to be underwater and you're not going to be cash flow positive? No, I wouldn't do that. So that's the first part of the question. The second is, what do you do with the money? Well, that comes down to your financial plan. If your goal is to, ramp up investments and try to reach financial independence really quickly and take on lots of risk, then you may want to take that money out and buy another property, with a reasonable amount of leverage on it. But it may be that, you got student loans sitting there at 6% and they looking like an awfully attractive investment these days when everything else is going down in value. To get a guaranteed 6% on it, maybe that's pretty good. Obviously, if you're going to borrow that money out at 8% and pay off something that costs you 6%, that might not be a good swap. But so you got to take the interest rate into effect there. But it's certainly something I'd consider. You've got a certain amount of assets, certain amount of money, and you can use it for all kinds of different things. All right, this one from someone on Facebook. What about commercial real estate versus residential? Do you cover this? Medical buildings, strip malls, storage units? Yes, we cover all that. We go over each of the asset classes, everything from, storage units to, long-term care facilities to student housing to, mixed units to billboards to, medical facilities to, industrial, residential, multifamily, single family homes. Yeah, we go through all of that. Now, I'm not sure what level you're looking for each one of those. If you're looking for a course that is all about retail, this is not that course. This is a broad, comprehensive course. But yeah, we touch on all of those units. Any interactive tools available through the course? I'm not sure what specifically you're looking for, a calculator or something like that, but it's not heavy on interactive tools. If you're looking for something with lots of calculators involved in it, we show you how to do the calculations yourself, build your own calculator in a spreadsheet, if you will, but we don't feed you a bunch of calculations or a bunch of calculators or tools like that. Okay, this one from W. Mitch 5. A beginner with no knowledge, will the course give enough confidence to choose the right kind of investment approach and be comfortable with dealing with it myself? Yes, that's the goal of the course, to take you from a beginner with no knowledge to being ready to invest and do it yourself, whether it's active or passive. So that's what the course is for. Sounds like it's perfect for you. Does the course touch on UBIT for IRAs? Yes, an extensive unit on UBIT. And why it's better to use a self-directed 401k than it is for a self-directed IRA if you're going to buy equity real estate, at least leveraged equity real estate. We go over that extensively. All right, this one from Colton. The Zero to Freedom course helps people to buy during this course. Would this course allow someone to do the same? You can buy anytime you want. Nobody's keeping you from buying. The Zero to Freedom course, this one's from our partners over at Semi-Retired MD. Their goal is to kind of take you by the hand and bring you to action, to get you to do something. And so each week of their course, there's an assignment, and you go through with a cohort and they try to keep you accountable so you move forward and actually do something and motivate you to do it. This course is much more about giving you information, empowering you to do things the way you wish to do it. And so while lots of people have bought properties while taking Zero to Freedom, we don't know if lots of people have bought properties while taking this course because we just started selling it a week ago. But I expect there will be lots of people who will. As far as helps people to buy, what this course does is it teaches you how to do that. I'm not going to call you up and take you by the hand and walk you down to a property and help you buy it, though. If you're looking for, somebody that will call you up and be your partner to, keep you on the straight and narrow of moving forward to buying something, this course may not be exactly what you're looking for. It does not have live components. It does not necessarily have a cohort that you go through with. It's more of a broad, comprehensive, information-based introductory course. All right, next question. Facebook is it possible to take a loan against equity in real estate? How is it different from stocks? Yes, you can borrow against your real estate. That's what you do when you buy a house and you only put down a down payment and take out a mortgage. You're basically borrowing against that equity. Once the equity is built up, you can borrow money out again. That's often from refinancing, or it can just be a home equity line of credit or HELOC. How's it different from stocks? Well, it's typically non-callable. If you borrow against your taxable investing account that's invested in stocks and it drops severely, you may face a margin call and have to put more cash in that account, or they start selling your stocks at a loss. That typically does not happen with real estate. They may not let you borrow more against your HELOC. They may raise the interest rate on your HELOC, but they typically do not call the loan. Obviously, you want to read the terms when you take out the loan. But yeah, you can borrow against real estate. All right, this one again off Facebook. Does the course cover the asset protection side of real estate and planning, liability, etc.? Yes, there's an entire module about that in the course. Okay, I think we're going to wrap this up. We appreciate your attention tonight. I think we've had over 300 people on here at any given time. And obviously, there's a lot of interest in the course. If you want to check it out, there's no risk to you. whitecoatinvestor.com/no hype. Check it out. Our goal is to teach you about real estate, empower you to add this to your portfolio, empower you to do it better, empower you to figure out how it fits into your life. The course never expires. Okay, so you can take it, you can come back, take it again, you can go back and review material. And that's one of the beautiful things about it. It's evergreen, self-paced, and from multiple instructors. We appreciate your time tonight. I know it's been late. A lot of you had a long day. Thanks for what you're doing out there, and thanks for your attention tonight.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.